pleasure to speak to you this week here at the Financial Inclusion 2023. My name is Tom Allen, and I'm one of the managing partners at Varvelium Consulting. Here is my fellow speaker.
Hello, everyone. My name is Eric Labar, and I'm an associate professor at North Carolina State University.
Today, we have the privilege to talk to you about some of the work we did together at Vision Fund International. That's the microfinance arm of World Vision International, back when I was the CTO at Vision Fund. Eric and I worked on bringing modern credit scoring methodology to the microfinance institutions at the organization to help better drive decisions for the loans that were being offered. Today, I'd like to start by introducing Phoebe to you. It's been a struggle for Phoebe, but she now sits proudly in her 3x3 meter tailoring shop in a busy market in the northeast corner of Nairobi. Every day, Phoebe wakes up at 5 a.m., prays, has her breakfast, and heads out to work. By 6:30 in the morning, her shop is open and she begins sewing garments for her customers. Phoebe's small business is her livelihood. It helps to feed her 6 children and her 3 grandchildren. There was a time, however, when Phoebe didn't even have money for slippers. Whatever she earned went to food and rent, and unfortunately, there was no money left. Now she can buy food, pay rent, and has even sent her children and grandchildren to school, and even has a little money left over to save. You see, Phoebe's husband died in 1989. At that time, her eldest child was 17, and her youngest was just 5. At first, Phoebe began to make clothes on her own, but she was unable to grow her business because nobody would lend her $10 and give her a helping hand. Her work was in demand, but she didn't have the means to grow. Phoebe heard about Vision Fund's microfinance institution in Kenya and took out her first loan for $100. She bought a sewing machine, fabric, and thread, and even before they asked for the money to be paid back, she was able to pay back her loan. Phoebe eventually bought the little shop where she now works, and she rents out another space in the market. Phoebe has taken out 9 loans since that first one, and her latest loan was for $400. Phoebe now employs 3 people to help her make clothes. It's clear that Phoebe was born to be a businesswoman, and she says that owning her own business makes her feel free. Phoebe is happy to know that through her business, she has been able to give everything she can to her children. All her children have been to school, and that means that they themselves can get any job they like. Phoebe's vision is to teach young people how to make clothes, then buy her own house and live a comfortable life. You see, these microfinance loans have the ability to help grow both individuals and economies. A lot is done through donations to organizations like Vision Fund International. Money comes into these organizations and the banks that they partner with. Then these banks loan out the money to individuals just like Phoebe. From there, these individuals start a small business. It could be a farm, a company sewing clothes like Phoebe's, a shoemaker, a hairdresser. But from there, these small businesses continue to grow and contribute to the local communities in which they exist. Phoebe's, for instance, hires other individuals in the community and provides more jobs locally to help others in her own community there. All of this sounds great, but where does data science, credit scoring, and what we want to talk about today play a role? For all of that, let me hand over to Eric.
Thank you, Tom. You see, data science and credit modeling, it's a common thing we're used to here in Western cultures. It's actually one of the oldest applications of data mining, as banks tried to use data to help decide the credit worthiness of individuals. Depending on which country you live in, you're probably used to knowing about a credit agency if you live in a Western culture. In the US, we have TransUnion, Experian, Equifax that report FICO scores. In Iceland or Ireland, you have Credit Info. In Germany, you have the Schufa. These agencies provide credit scores for individuals in the Western world. We have generally a good idea of what these things do. Some might say they are a gateway to getting a loan. More formally, they are the front-end representation of a probability of default algorithm. We all probably would not like it if someone told us we had a 10% chance of defaulting on a loan. Instead, they say you have a 650 credit score. Not everyone knows the math behind it, but we do know that higher is better. However, in some developing countries, they don't have these agencies to lean on for information about creditworthiness of individuals. Now let's go back to these microfinance loans. How do we determine who to loan money to? This is where we have been blessed to help use our experience in credit modeling and data science. Through the use of modern techniques in credit modeling, we are helping these banks and organizations like Vision Fund International try to determine which of their applicants for loans are more likely to default or more likely to pay back the loan. They are trying to be good stewards of the resources they have been provided. Every time they make a correct loan decision, money comes back, and they can loan to another individual. Every time a loan isn't paid back, there is an opportunity lost for an individual who won't be able to get a loan. Through the use of these machine learning processes, we can parse, manipulate, and extract the important features from the data sets these organizations have to help them better make loan decisions. We built credit scores, much like the one we have in Western culture, to help provide insight to these loan decisions. Some of these banks had tons of data, while others only had a limited amount. For example, one of the banks that we worked with had only a little over 70,000 total customer transactions. We parsed this information down to just around 3,000 individuals and the information we had when they first applied for a loan. We took the 76 pieces of information they had on these individuals. Everything from name, address, age, to number of children, what type of business they wanted to invest in, location geographically, and so on. After adding some of our own pieces of information, the machine learning algorithms identified 8 important variables that most determine the creditworthiness of the individuals at this specific bank. These 8 pieces of information is all that a local bank needs to collect about an individual to adequately make a loan decision. This makes the process of using this information much easier for the individual bankers assigned to make loan decisions. From these 8 variables, we developed a credit score, as I mentioned earlier. Now, this credit score didn't have the same ranges as we would have here in the United States, for example, since we customized it to the individual bank we were working with. In fact, I showed this histogram of the credit scores to the decision makers at the organization, who Tom was at the time. On the x-axis, we have credit score, ranging here from 450 to 730, broken down into bins of size 20. On the left-hand y-axis, we have the number of people at the bank that fell into those credit score bins that make up the histogram. On the right-hand y-axis, we have the percentage of individuals from that credit score bin that actually defaulted on the loan. This plot helped the organization's decision makers see that people with higher credit scores defaulted at a lower rate than their overall bank's default rate of just under 8%, while people with lower credit scores had defaulted much more frequently. They could then give the results of these credit models to their individual bankers on the ground making loan decisions. I could say more, but I'll let Tom take over from what happened from there.
Thanks, Eric. As you can see, a lot of thought went through the process to get the scores and to get the recommendations. But having theory and academic views and not applying them to the real world would have been a waste. So what did we do? We took the opportunity to influence the way in which we encourage, train, focus, and report and manage what our loan officers did. We were able, in some instances, as Eric has pointed out, to hone in on those areas where sensible credit decisions and loans would make a difference in communities. It also allowed us to look at some of those areas of risk where we wanted to make some deliberate action in terms of going and understanding what was happening with the client base and actually taking some further risks that we wouldn't normally have done if we didn't have this data available to us. Consequently, we found that both our loan book and our risk book increased, but we were able to protect against losses because we understood our business better. We were able to help people in a way that we hadn't historically been able to do so with the knowledge and understanding that we now had. These weren't just academic data points or thought processes. These were actual practical influences into the way in which we lent money to the right people for the right reasons in the right way. It allowed our people and our processes to take time to think about what we were doing and why. And ultimately, it made sure that the things that were important to us, as in the impact to make sure that our donor funds were being used in a sensible, efficient, effective way, was happening in the field. We wanted to see other stories like Phoebe, who we talked about earlier. We want to see other individuals and families and communities blossom and grow because we use data effectively. And that's what happened. It wasn't just in one location either. We took this same work that Eric did, and we did that in Asia and Africa and in South America. And whilst there were differences in the markets themselves, and there was differences in the businesses as things grew, the correlation, the detail, we were able to make and understand what we were doing and why, and ultimately change our businesses on the ground. That has continued. Since I've left Vision Fund, I know that they've continued to develop this process, look at ways that these things can happen. And now, as Eric and I and others at Valvalium look at ways that we can help other clients that we now support, we know, we understand, and we can apply this data in ways that we know ultimately finds its benefit to the field. So be encouraged by the fact that data, this process, the academics, the process that in some way, shape or form seems so far from the field, actually ultimately can and does have the impact that you and organizations desire. Please reach out to us. Aaron.
Thank you all so much for joining us today, as we talked about credit modeling for developing countries so that we could improve the lives of families. If you have any questions, feel free to reach out to either of us. Our information is here on the slide. Take care and have a good day.